right here is a classic shakeout pattern that you see, and it really starts kind of right where this volatility starts at 745, and it continues down here. So one of the first things that you look at in a shakeout is for a trend, and it's usually a pretty long, strong trend, okay? And you can see it, and I'm going to thicken this up a little bit. And you see it right there, you know, I mean, it's a pretty clear pattern, you know. We're right about here, and then, you know, we continue right around here. And this is actually the shakeout that you're seeing right here. Okay, and, you know, so one of the things that defines a shakeout is a deviation from trend. Okay, so, you know, we're moving in a consistent direction, and then all of a sudden something drastic happens and the market moves down even more and then back up the other way. So I'm going to kind of turn this into like a fantasy here and tell you a little bit about what's going on and, you know, make it like kind of funny, and then I'm going to tell you a little bit more of the mechanics behind it. So, you know, you got a lot of traders in here, okay, and people are buying and selling, and the market's moving down at a good clip, but, you know, people are in different positions, and there are probably a lot of people that are in long positions hoping that the market's going to recover somewhere in here and take off. And, you know, imagine if, you know, you're in a long position like this, okay, you're 5 contracts long, okay, and what you do is you put a protective stop down here, okay, to hold you, okay, and it's a sell order, okay, and that means if it comes down to a certain point, you want out of that, okay, you know, and you don't care how far up it goes, okay, so this protective stop down here is a sell order, okay, and you're into a long position, a buy position up here, okay, and you know, you're pretty comfortable with this, okay, you think that the market's going to go up, there might be some volatility this morning, but you think when the Europeans decide that they're not going to raise interest rates, you know, the market's just going to be a strong up day today, okay, and that's your guess of what it is, okay, but just in case you put that protective stop down there in the bottom, okay, you can't see it anymore, it's down way below, but it's still there, okay, I can see it right here, sell stop, okay, and then I hop off and go to the golf course, okay, because I really do like to play golf. Now, I hate golf, actually. But, you know, a lot of people fancy themselves as day traders and afternoon golfers. And, you know, they think that everything's set now. They can't lose because they got their protective stop in. Okay, and then all of a sudden, usually triggered by some bad news or something like that, the market falls, okay, and that's what you see right in here. The market starts to fall, okay, and my protective stop may be lower, okay. Let's just say my protective stop is way down in here, okay. Now you got a group of pretty savvy traders, and I think we were talking about these guys yesterday that manipulate the market, okay, and typically they work in organizations. You know, they work for a company and they're trading other people's capital, you know, one person's capital in most cases, and they know what they're doing, okay? They know how to manipulate the market, okay? And you might have heard the term stop hunter, okay? That's something that's common, okay, a stop hunter. And, hey, Mike. And, what you see here is the market's starting to get dragged down, okay, by natural causes, and then all of a sudden these guys say this is a good opportunity because guess what? They see the level 2. And what was the level 2? The level 2 are these orders that are sitting on the side. Now, you and I on my dome can only see so much, okay, but other people can see these things going on and on and on forever, okay? There's orders stacked up. It's called level 3 data. There's other ways to view that stuff, and they see what's going on there. So let's just say you have $1 million, okay, or $2 million. Well, how many contracts can you sell or buy with $1 million? Probably a fair amount, right? Let's just say you have 20 million or 30 million, which really isn't that much money for a hedge fund or a big institution, you know, or somebody that's really, you know, throwing the market around. Maybe they have $100 million. So let's just say they sell another 2,000 contracts. Well, what's 2,000 contracts going to do? Okay, well, this is 4,600 contracts in this red candle right here. So 2,000 is almost half. And if there's already a panic and the market's already headed down and they throw another 2,000 short into it, it's going to push it down even farther. And it's going to start hitting these stops. And remember my stop. What was my stop? It was a short. Sell, stop. So as it hits my stop and my stop gets sold, it's going to force the market down even more. And all these other people that have short positions, okay, short stops down here, or they're trying to get out of positions and they have to sell to get out of positions, they're going to start getting hit. And it's going to create like this avalanche effect, okay, because they need to close those positions. Okay, they're sells, they're sell orders, okay. I can just hit close and get out of that, and you know I made $105. Okay, but if it goes down and down and down and down, I'm going to be losing money, and eventually my stop is going to get hit, and then it's going to force it down even more. And imagine that's what's going on here. That's called a shakeout.